Master your money, free your future. Welcome to Budget for Life. Hey, my name is Jeremy. I'm not a professional YouTuber. I am a financial advisor. But this video is not financial advice. This is for your education, entertainment. I'm here to break down some huge takeaways from this bombshell interview Ryan Cohen just gave about GameStop. And some of them are read in between the lines moments that you might not have heard. If you just read the transcript, you might not have deduced. But I want to talk through it with you guys. I want to share my reasoning with you guys. Some really, really impactful, meaningful, substantive takeaways as far as modelable takeaways, implications on GameStop's business that Ryan Cohen shared. And I want to start with mostly chronologically, but I kind of want to go in ascending order or descending order, whatever you want to call it, like least important down to some of the most important takeaways from the interview. What's up, Steven? What's up, Charlie? Thanks for being here, guys. So this is the interview. If you haven't seen it already, it's out here. And so anyways, there's the link if you want to look it up if you haven't already seen it. I want to get into takeaways and also show you the implications real quick. Just want to say thank you to those who have joined the channel. Thank you to the subscribers. Thank you to the viewers. Almost 5,000 hours of watch time. Congratulations on educating yourself on all things GameStop and looking at things from a level-headed perspective, which Ryan Cohen is helping us do. And the super encouraging thing is the level-headed perspective is actually far more bullish than in this video I just made valuing the collectibles business. It turns out my level head was way too bearish, and actually that the closer to reality is what just 24 hours ago we would have said is maybe hyper bullish. And so let's get into some of those takeaways. What's up, Bob? What's up, McDougal? What's up, Jason? Glad y'all are here. Excited for y'all and thankful for y'all. So here we go. Takeaway number one, cost cutting and efficient productivity. So they went from, in 2021, they had 1,400 people in corporate, and now they are down to 400. So they have cut over 1,000 stores in that period of time. And of course, employees specifically related to those stores. But we're talking about home office, corporate jobs. They have cut 1,000 corporate jobs in just the past 4 years. And yet the company is more productive now than it was then. This is Ryan Cohen's words. This isn't just me saying that it's more productive. And Ryan Cohen said, no question that AI and tech has contributed to that increased productivity. I took note of that because, some people think GameStop is such an analog business. It's stuck in the 90s or stuck in the early 2000s. But the reality is that they are a tech-forward, AI-forward operation as far as how they manage themselves in corporate. And you can see it in their SG&A. So back in 2018, 19, 2020, 2021, their SG&A was almost $2 billion a year. And now we are on pace to come in at under $1 billion for the full year of 2025. And what they've also started doing recently is splitting how much of that SG&A is related to their stores and how much is not related to their stores. And a key financial implication to this comment from Ryan Cohen. So they've cut 1,000 jobs, and yet the non-store related SG&A and the total SG&A, basically, without a doubt that some of this SG&A is related to severance packages, is related to the cost of closing stores, which we've speculated, and they've also said, hey, our SG&A is coming down, but it's higher than it would be because we are experiencing costs related to these closures. But when your workforce is cut by, what is that? 70%? I don't know off the top of my head. You could expect that this non-store, and they started reporting the difference between store-related and non-store, that they are interested in showing you just how low of a number they can make this non-store figure to be. And on pace, it's this year, it's going to shed at least another 10, maybe 15 or 20 million off of the non-store SG&A, aka home office, corporate office. So huge, because obviously they're continuing to cut their store count as well, and their store-related SG&A is going to keep coming down as well. So really awesome to see that. Number 2 takeaway, cash for crash. So a lot of people, as it relates to GameStop's cash and securities, they say, why won't GameStop just deploy this money already? Like, I just want to see them put this money into another business acquisition. And some people think that GameStop's not even valuable until they do purchase other businesses. But Ryan Cohen confirmed, he said, for us to use this cash, it needs to be a situation where the downside is very limited and the upside is very high. And then he continued, he said, we are not incentivized to deploy cash. This is a huge statement. He's saying we have no reason to use this cash. Actually, we are more comfortable with our valuation as a company, locking in that cash value and avoiding stretching ourselves too thin or taking on too many different risks. He said if we were private equity or a VC firm or a money management firm, we would be feeling pressure. Oh, we got to figure out what we're going to do with this cash. But in GameStop situation, he's like, we don't have to use this cash. Like, we can let this cash be cash. Literally at 0% debt. Some of this cash is already diluted and it's not debt. Some of this cash is on 0% debt. So all this cash, they aren't owing any money for, and it's making them money. And Ryan Cohen says, I have no problem with this interest income impacting our business. I have no problem taking home $100 million of profit a quarter. There's nothing wrong with that for me. And so the interviewers asked, so are you waiting for a market crash? And that's been part of the speculation related to this cash pile that GameStop's been building. And Ryan Cohen, again, read between the lines. He starts off by saying, well, financial markets, you never know what could happen. It could be green. And the next day we could be in a crisis. And then he says, when that happens, we will be in position. So does that mean that if the absolute perfect acquisition opportunity came up right now, that GameStop would not use this cash? It doesn't quite mean that they won't buy something sooner, but it does confirm that they will maintain a large cash position up until and through an actual broad-based market crash. So that's been a big question investors have had, and Ryan Cohen basically just told you that is a huge takeaway. And it limits downside if you're buying companies in a crash, because obviously they've already gone down in value. And if you believe in the fundamental value of the company and you can project it, right, then you can have a high level of clarity for a high level of upside and limited downside. And so another takeaway within this number 2 is that GameStop, what is GameStop going to buy with this cash? Ryan Cohen's comments, possible that they do buy just some publicly traded securities that they're not interested in having an active management role. Like Berkshire Hathaway, Berkshire Hathaway has companies that they have bought that they manage, like See's Candies and Geico. And then they have companies that they just have huge public stakes in, like Bank of America and Chevron and Coca-Cola. So I think Ryan Cohen is 100% interested in both of those strategies. I don't think all of this cash is going to stay in cash forever. And I don't think it's all going to go into buying companies outright that he wants to, turn into part of a synergistic portfolio of privately owned companies. I think he wants to do some of that. And I think he also wants to have some of publicly traded securities that he just has really great cost basis on. Like if he can, like we know he likes Apple or has liked Apple in the past. We actually don't know how bullish Ryan Cohen is on Apple now. But if Apple's down 60% or something, I think it's totally viable that GameStop says, yeah, let's go ahead and take $500 million and buy Apple stock. I think that's more likely now, and that's not something we would have necessarily projected sooner. What is up? Welcome to the newest friend of the channel. If you want to tell me like how to pronounce your name in a dumbed out spelling way, I don't want to just butcher it right here, but thanks so much for joining as a member, for joining as a friend. You'll see the posts on my member only posts to get access to my client only communication. And also if you want me to share my GameStop spreadsheet with you, there's a post on there. Arca. Okay. I can do Arca. Arca from Poland. Yeah. Alibaba is another company that Ryan Cohen's been more public lately in positive comments about, or at least they asked him about it in his CNBC interview. So yeah, most important is it's not happening until there's a crash. It could happen in some little situation before a crash, but basically it's not happening until a crash. Number 3, the YOLO no. Okay. So Ryan Cohen said, oh, what's up? Arca's been here for 2-3 months. Man, welcome, dude. So pumped to have you as a friend. So he said when he started GameStop, his initial strategy was to copy the Chewy playbook and to be the everything store for gaming. And we talked about this in my my video that blew up and kind of got this channel rolling. The in-game is here for GameStop. We talked about how in 2021, Ryan Cohen's first year, like they just bought inventory and sold as much as they could sell. So like their sales were actually up 20% year over year, full year 2020 to full year 2021. They were just buying a bunch of stuff and figuring out what worked, right? They grew inventory by almost 50%. And it's interesting to hear Ryan Cohen say, yeah, basically that was a mistake. Like a lot of the stuff that we bought didn't sell well, and we actually had to mark it down. And even some of the fancy new hires, if people were following GameStop back in 2021, part of the confidence that investors had in buying into the transformation was, look, they just got this person from Amazon. They just got this person from Facebook. They just got this person from Chewy. Like, why would these people leave super high-end jobs to go work for GameStop unless the transformation was inevitable? And it turns out the reason why they would is because they were paid super well too. Like GameStop paid a premium to get that premium talent. And GameStop was riding on the coattails of the investor vibes, like the degenerate gamblers that are YOLOing into GameStop stock, which I was one of them, and really YOLOing into out of the money call options. Like all of the hype of the short squeeze, Ryan Cohen was basically betting that retail enthusiasm would convert to really strong business sales. And the reality is that most of the people invested in GameStop were not doing enough buying from GameStop product, and instead were just hodling their GameStop shares. And so at the end of the day, all that stuff they bought, they're like, well, it turns out this isn't going to be that easy. So GameStop was really probably hoping for a super quick transformation. Say, hey, we got all these people following us. We've transcended financial news as this meme stock. Like, let's just buy a bunch of stuff, sell a bunch of stuff. Let's do NFTs here. Let's get more and more product lines here. Everything we make is just going to pop off the shelves. And it turns out, no, this was going to be a long, hard fight. And so it was interesting to hear him reflect on that, because it has shaped, and you'll see in the next couple takeaways, it has shaped the way that he is looking at growing GameStop moving forward. And basically what he said is that he's pretty risk averse. Like this YOLO no, this costing shareholders money, thinking high growth was imminent and it turns out it wasn't, has turned him a little bit pessimistic in terms of how he tries to allocate GameStop's money. And he's really only taking the no doubt singles, doubles, triples, and home runs. He's not going to try something if he's not sure it's going to work. And again, that matters, particularly when you think about, well, what's GameStop going to do to transform their business? What are they going to do with this cash? What are they going to do to add new lines of revenue? They're not going to do something risky. And he said as much in takeaway number 4 as well. Game development is not happening. So once eBay just got bought privately for like 55 billion or whatever, some people thought, man, sure seems to be a lot of money in the game development space. And that would be not easy to succeed, but a lot of synergistic markets, a lot of the same people that buy video games from GameStop would buy video games from GameStop, made by GameStop. Like to have some wholesale made in-house GameStop, the video game developer, video games is an adjacent business to their current business. And some people thought, hey, maybe that's where they want to go. But it's not. He's not going to. And again, read between the lines. He didn't say verbatim, we're not going to develop games. But what did he say? He said a couple things, but he said, we operate our software business in a CapEx light method. And the interviewers were asking him like, hey, you saw this, EB Games sale, like you see these other developers, what do you think? He said, we're operating CapEx light with software, easy returns, no moonshots. So again, another takeaway within the takeaway is that the software business bull case is not a high probability scenario. GameStop is not investing money into software. GameStop is just selling what they can sell in software. If someone wants to sell their used game to GameStop and GameStop can make a 40% margin, GameStop's going to keep selling that. But literally, Ryan Cohen said the video game market is definitely going from physical to digital. Ryan Cohen just said this. So we've been kind of hyping up GameStop Twitter. They've been doing a lot to try to push out, hey, physical games still having a place. We thought, hey, maybe it's going to slightly invert or maybe kind of bottom out and flatline. Probably not. Ryan Cohen just said the video game market is definitely going from physical to digital, aka the trend is still continuing. And our capacity to compete in the digital space is limited. So software sales are probably going to keep going down unless, again, the moonshot of PSA graded video games, does that invert? Does that create a floor? That is still possible. But Ryan Cohen's not spending money trying to make that happen. Like if that happens, he's going to say, great, I'm glad that happened. But he's not going to try to make that happen. And he's not going to try to compete in an expensive way in the digital space. So if he can sell you a pass, a Xbox Live pass, if he can sell you some type of digital store pass, gift card you want to buy from GameStop, great. He'll sell those things. But GameStop's not going digital in the software space, which is really, again, a huge takeaway for GameStop investors. It's clarity that we did not have before. But it doesn't mean their software business is worthless. Again, you can still value their business. And there are implications to what did Ryan Cohen say with how would you value their software business. I'm going to save this for future videos to really nuts and bolts kind of remodel. Okay, based on what he just said, what are the scenarios floor, fair, and fly, and then what are the probabilities of those scenarios. But suffice it to say, the software business is maybe worth a little bit less than a 2.2 billion on a weighted average basis. Now, takeaway number 5, hardware. Ryan Cohen is not bullish on wearables. Like, hardware business means consoles, video game consoles, and it means accessories. And maybe a little bit of PC, maybe a little bit of phones, right? They're doing some of that, but it's not VR. It's not the metaverse. Ryan Cohen literally said MetaQuest is a joke. And I'm pretty sure they do sell the MetaQuest. So for him to publicly say that is like really not like a PC move, but he's not a PC guy, obviously. He also said that AI glasses look highly regarded. Okay, so congrats. Congrats to any of us that are highly regarded as well. He said, again, if he can sell any type of VR tech or wearable for a high margin, he'll sell it. But he is not bullish on wearables. And as we model out the hardware business, as we think about, again, their floor, fair, and fly scenario for hardware, you do not want the narrative of, well, what about the MetaQuest to be a significant factor in your hardware, particularly as you think about the cyclicality of the hardware business, like very dependent on console releases from Xbox, PlayStation, and Nintendo. And then you supplement that with sets. That's basically not changing anytime soon. Hopefully, that cyclicality, the floor can rise each time, and the spikes of those new cycles can rise a little bit higher. But it's nothing to hold your breath for as far as are there other hardware lines that will make a substantial different trajectory related to the hardware business. The other takeaway within the takeaway here is basically Ryan Cohen just said, yeah, your valuation for hardware and software is probably just about spot on. I'm not saying he's saying that to me specifically, but he's saying that what you see happening with software, the transition from physical to digital, yeah, that's happening. And we're not going to compete in the digital space, and we're just going to take the easy returns. What you're seeing happening with hardware, the cyclicality, the dependence on new console releases, yep, that's where we're at. So these two takeaways are so important because it sheds that much more clarity on what he said about the collectibles business, which is so clutch, so important. The fact that not a lot of change is happening in hardware and not a lot of change is happening in software means that these two businesses are very easy to model, relatively speaking. And what we have had a hard time modeling is the collectibles business, because that's where they're investing so much growth, right? That's where they're changing so much. They have the power packs, they have Lego, they have in-store power packs, they have the partnership with PSA, and they've just started all these. And so how do we know how much they're going to make on power packs, right? We know actually with a pretty high level of clarity, at least what that initial growth curve is looking like, thanks to this interview. And I'm going to get into those takeaways soon. First, another takeaway, Roaring Kitty and Ryan Cohen have spoken. Okay, this is me between the lines. You can disagree. We'd love to hear in the comments, in the chat, whatever. But they asked him, what's your relationship like with Roaring Kitty? Do y'all talk much? Huge silence. And he says, ask him. Now, there's another moment in this interview, and there's another moment from one of the CNBC interviews he did a month or two ago, where basically anytime he gets asked a question that's a dead-on question, where his answer to that question could warrant some type of investor hype, could warrant some controversy, could warrant some kind of meme-ness, he deflects the question with a question. This is an hour-long interview where he's answering all sorts of stuff straight up, giving a lot of insight on a lot of things. As soon as you ask him a question he doesn't want to answer, he says an answer that is a question. Another way he does this is, what do you think? I think that's what he said with CNBC. And then the host said, "Oh, we'd love to have him on the show." And Ryan Cohen shouts, "Get him on the show." And then also, as far as Ryan Cohen's, what does he think about Roaring Kitty? He says, "We don't want day traders. I'll have a conversation with him if he's focused on decades and centuries, not on making a quick buck." So he did say, "I'll have a conversation with him." In my opinion, he's talking about if they get him on the show, Ryan Cohen is happy to also join on that show to have a public podcast conversation with Roaring Kitty, which would be epic. I mean, drop a like on this stream, on this video. Let me know in the comments, would you want to see an interview with both Roaring Kitty and Ryan Cohen together in the same interview? I mean, I think that would be epic. I think if his answer to this question was no, I haven't talked to him, that would be what people would want him to say. Like, that would be what mainstream media would want him to say. They would want him to say, no, I haven't talked to him. Like, yeah, I've seen memes. Like, it's cool. People are excited about the stock. No, I don't have a relationship with him. Instead, he said, ask him. I'm not saying they're pals. I'm not saying they're friends. I'm not saying they're scheming up some type of insider situation. I'm not saying he's tipping off DFV so that DFV can take plays from Ryan Cohen on how to trade the stock. I'm not talking about anything like that. I'm just saying they have definitely had a conversation. And as a GME investor, to me, I think that is exciting. Number 7, let's get into some of the best parts of this interview. Power packs will be worth billions in its own right, and they have a modest gross margin, but Ryan Cohen doesn't really care because it's scalable, high ceiling revenue, and low SG&A. Again, let's get into how am I able to take this takeaway from the interview. Ryan Cohen says, if we can make 80%, they just kind of asked him a general question about growing the business. He said, if we can make 80% margins on anything, but the upside is limited, it's not going to move the needle. I don't care. So as we talk about the collectibles business and we talk about GameStop's power packs, right? We have been wondering, how does GameStop account for this business? Are they just getting basically the 60% profit, but they're like, who's buying and selling the cards? Is it PSA that's doing the buying and selling and GameStop that's receiving a commission? Or is it vice versa? In reality, it probably is a blended experience, but we know a lot from what Ryan Cohen just said, because what he's basically saying is, he's basically saying we are buying and selling the cards, and it is actually relatively low margin, but I don't care because it is supremely impactful for our business. So let's go into the financials. In this collectibles video, we talked about how we're going to project Q3. Basically, we were talking about power packs, how much revenue are they going to do? And if GameStop receives a 6% commission, like they're just receiving a seller's fee from PSA for generating those sales, then they might net, maybe $3 or $4 million of revenue, but essentially there would be no cost of sales with that. It'd just be a raw commission from PSA. And so all of that $4 million would be gross profit and would help the margin numbers. Basically, Ryan Cohen literally is telling me and everyone, hey, I don't care about making 80% margins if we're talking about $4 million a quarter. 80% margins on $4 million is not going to move the needle. But if we're talking about something that's going to translate to billions of dollars of shareholder value and it's scalable, then we're talking. So he's saying if this collectibles number can be more similar to what we've seen from Courtyard, right? $100, $200 million a quarter, right? even if we're only making 10% margins because we are buying them back at 90%, that number means so much to the business. Not just, I don't think Ryan Cohen cares so much about the top line. I don't think he cares about impressing with the revenue number. But what I do think he's saying is 10% margins on $150 or $200 million in revenue. Well, guess what that is? That's 15 or $20 million of operating income, netting out whatever SG&A is. And this is the other part of what he's saying is that Power Packs is scalable. It is scalable. What does that mean in financial terms? It means that the revenue of Power Packs, the revenue of digital Power Packs, basically does not cost them anything from an SG&A perspective because it's all digital. Everything that they sell in store, they have to have a store, okay? And then they have to have employees working at the store, right? And they got to deal with crazy customers that make the lines take longer, right? All of these costs related to any of those in-store sales put somewhat of a ceiling on how much are you going to net if you start investing more and more. Like, let's say GameStop converts all of their physical stores into bona fide card shops. You're still having to pay money to keep the store open, pay money to the employees to run the store, etc. GameStop is basically saying, we would rather just sell them right here and make a lower margin per sale because it doesn't cost us anything else. The only thing it costs us is the cost, is the cost of the card. Whatever we pay for the card, that margin, that's what we're going to make. We don't really have to, we've already built this. No one's manning this, etc. And so all of a sudden, super high growth, top line, lower margin, but low SG&A means more operating income dollars. And you're talking about, like we just said, hey, maybe 15 million of operating income. Well, that's off the jump. That's almost a 25% increase in the whole company's operating income, right? And this whole company right now is a $10 billion company. And if you just increase it by 25% off the jump, well, then, yeah, this is already billions of dollars of shareholder value. And they asked them, they kept going. They said, do you think Power Packs could be that? And here we have another long pause and deflection. What do you think? That's Ryan Cohen's way of saying, yes, of course, Power Packs, even if the margins aren't crazy, even if the gross margins aren't crazy, the net margins are going to be pretty solid because there's no SG&A, right? The cost of sales might be high, but the SG&A is going to be low. And so ultimately, the dollar figure amount that this is going to make on operating income is going to make it worthwhile. And even though they're operating at a 10% margin, it's not a high risk 10% margin because this is literally appreciating assets. But they asked him, he said, what do you think? He said, well, chat's going crazy. People want to know. They're asking him, come on, tell us. Ryan Cohen says, Power Packs is interesting. We can't get enough inventory. I don't even want to say anything because customers can figure it out for themselves. Woo! What a huge tell from Ryan Cohen. How would customers be able to figure this out for themselves? Okay. Right here. You can't figure out for yourself right now how much money they're making on this business. There's no way for a customer to know. You can buy a car from the business, but you can't know how much money they're making. And they're saying, hey, how do we know that Power Packs is going to translate to billions of dollars of shareholder value? And he's saying, well, basically, yes, it is. And by the way, you could figure it out for yourself. So if you were to take Courtyard, which is the most similar product to Power Packs, and say, okay, when did Power Packs Beta come out? Power Packs Beta came out in basically the last day of July, first day of August. What has happened to Court? And it was a very tight beta at first. So, okay, they're making 68, $63 million in sales to boom, the first full month that Power Packs is out and the beta's spreading a little bit wider. $30 million off the books from Courtyard. Right now, we're 2/3 of the way done of October. October's on pace to do around $11 million. So what's the gap there in just 2 months? $50 million per month of revenue. And the only catalyst for this is literally Power Packs. Nothing else changed that would say, oh yeah, this business line that's been growing month over month, right? And then kind of steadied at a 60 to 65 million for 1, 2, 3, 4, 5, 6 months, just all of a sudden fell off a cliff. I've wondered, I've speculated, I've hoped that this is the impact of Power Packs. But Ryan Cohen's telling you, yeah, this is the impact of Power Packs. Straight up. So, takeaway number 8. Digital Power Packs is indeed lower margin than physical Power Packs. I thought their physical Power Packs would be done. I thought once they came out with the digital, they weren't going to make these anymore. It turns out they are still going to make these, which is awesome because they limited it to 1 per person and lines were still out the door and they sold out same day. It's just a great vibe to get people in the door, people in stores. Some of those people buy other things. Let's keep it to the takeaways though. But so they're still going to sell physical Power Packs and they're going to sell digital Power Packs, but they're focusing on the digital even though they are lower margin. So they asked them, like, is Power Packs, is it kind of similar to how Chewy started with consumption products like litter and dog food? And Ryan Cohen asked, are you talking physical or digital? So this physical, they're going to keep doing this. This is a part of their business now, which I think is awesome. It's mostly awesome to get people in stores, but also if they've got 2,000 stores right now, and how many do you think they had per store? 10, 20? It's like, well, and what do they cost? $50? Like, well, what's 2,000 stores times 10 a store is 20,000. And if they're $50 a pop, that's literally $1 million in a day. And that's if they only have 10 per store. So they probably have more than that, right? Regardless, easy revenue and going to continue to be part of their business. And they said, well, we're talking about physical. He said, I like the trading card space. It's not a marketing thing. We can't get enough inventory. Now, this was in reference to physical because they said physical. And then he said, but digital is more scalable. So we're going to be more interested in scaling digital, but still can't get enough inventory. And then he says, now you could pay 110 or 120% of market value to get inventory, but we aren't going to do that. To me, and then he says, well, no, this is not what he said. This is me kind of taking away, reading between the lines of what he's saying. Physical, GameStop's paying a 60 to 70% market value for graded cards. Like when you talk about GameStop.com, like the traded cards that you can buy from GameStop, separate video, but basically they're offering 60 to 70% of value for cards that they can then sell in store. And yet on Power Packs, the digital Power Packs, they're giving you an instant offer of 90% back. So that's GameStop's way of saying we are investing more into digital. Like we will spend more to fuel the digital inventory because we think that digital Power Packs has a higher ceiling and lower floor of the impact it can have for our business. And I think GameStop is indeed paying 90% because Ryan Cohen offered himself. Now you could pay 110 or 120%. Now, why would he say that if they're only ever offering 60 or 70%? Now, y'all probably are like, well, duh, they're not only offering 60 or 70%. Like, they do the 90% instant offer. Yeah, of course, but we didn't know until Ryan Cohen said this. We didn't know if that 90% offer was truly GameStop's or if it was PSA's. Is GameStop just getting a cut for facilitating it all, or is it really GameStop making the offer? Ryan Cohen is saying GameStop is the one making the offer, which is takeaway number 9 to tie these last couple of takeaways together. Digital Power Packs is primarily GameStop's business. PSA is the one receiving a cut. Obviously, PSA cards are in here too. In reality, it is a blended experience. Sometimes it's PSA's card. Sometimes PSA is the one getting the offer. But when you do the instant offer, it's GameStop that's getting the card. And GameStop is sending as much inventory as they can to be a part of their digital packs. This is not just a couple $1 million that GameStop's getting on commission. This is GameStop's baby. This is GameStop's child. And that is huge because we didn't know that before. Last takeaway. Holy smokers. This ain't no jokers. Collectibles growth. So, again, Power Packs really is behind this courtyard dip. And the collectibles really is growing like crazy. Ryan Cohen said, trading cards are doing very well, taking collectibles business from nearly 10% of their business to just about a third of total sales for full year 2025. We're selling our card products very quickly. The more products we have, the more we can sell. Full year 2025, close to a third of sales. So what does this mean? In a recent interview or a recent video, again, we speculated 271 for collectibles. Well, we know with pretty high clarity what hardware and software are going to do. Like we know historically, software, the percent of a Q4 sales, software sales, like, let me say it a different way. 29% of GameStop's full year software sales happened in Q4. That the year before was 31%. The year before was 37%. So again, is this going to quite possibly? So if we were to the software sales for 2025, we'd say, well, what if it just continues to go down? Like it's been going down 26% year over year the past 2 quarters. And we modeled that to flip a little bit. What if we said this is actually more like 200 million here? And let's say it just, or even let's say it escalates, right? If you think this is going to be 185 in Q3, then you're basically looking at what is Q4 going to be to get that number around that 29% figure. Again, plus or minus 50 million, software is going to do somewhere between 700 and $800 million in 2025 with a high level of clarity. Like, again, plus or minus 50 million, not a huge swing when you're talking about a maybe $5 billion annual revenue. And then talk about hardware. So hardware, last time there was a console cycle, hardware in Q4 was 39% of the hardware sales. So of the $3 billion that they sold in hardware, oh, sorry, I'm covering that up. Of the $3 billion that they sold in hardware in 2022, 39% of it was sold in Q4. The year before that, 2021, 37% of it was sold in Q4. And we know, like, when Ryan Cohen says a third of the collectibles, a third of the company sales are coming from collectibles. He's not saying that Switch 2 sales are falling off a cliff. Like, we know that Switch 2 is going to sell. It just came out in Q2. So software, he said some bearish stuff. Maybe software is going to continue to be down a little bit further, but it's not going to evaporate. You want to call this 700 instead of 733? Fine. It doesn't really make a difference as far as trying to figure out what does this comment from Ryan Cohen mean for GameStop's full year sales and for the growth rate of their collectibles business. With the Switch, there's no way that hardware is going to sell less in Q3 than it did in Q2. It's just not going to when the Switch literally just came out. And then you're looking at what's a number in Q4 that gets you around that 37 to 39% that we had last console cycle for the relative annual sales, specifically for hardware. So on the low end, you would say hardware might do 950 in Q4. But if you wanted to get that number closer to 39%, you'd say, well, they might do 1,050 in Q4. It's more likely to be 1,050 than 850. But again, you want to call it 950, and you take these two numbers together, about 3.3 billion in full year sales for hardware and software, plus or minus 100 million, right? Like a pretty high level of clarity. And you also in Q4, by the way, you're supposed to have the Microsoft handheld thing come out, the Switch competitor for Microsoft. So we'll see if that even happens. Regardless, if there's 3 lines of business in GameStop, and with a high level of clarity what 2 of them are going to do annually, then what annually the collectibles business is going to do. If you say that just about a third, he said nearly 10% to just about a third. Well, nearly 10% was 13% in Q4 of 2023. So let's give a 3% margin of error. Ryan Cohen called this 10%. So let's say he calls 30% nearly a third. 13 is nearly 10. 30 is nearly 33. That means collectibles is going to do 1.4 billion in sales for the year. But here's the thing. They've already logged half of the year, and it's 440 million. So that means between Q3 and Q4, they are going to do at least $1 billion in collectibles sales. And he said this on October 20th. Why would you say this on October 20th unless you knew that this is going to be the case? Let me say it a different way. It's already happening. He's not saying that, in Q4, it's about to go off. Like, it's not going to be 271 and then 735. In reality, this 271 that we modeled is probably more like 371, right? And then this, or maybe even closer to 421, And then this Q4 would be more like the 550 or whatever. Now, I'll go back and think a little harder on how exactly do you split Q3 and Q4. But if this Q3 was 300, you just wouldn't make the risk of communicating that, it's 300, which is growing nice, right? 300 compared to 227. I mean, quarter over quarter, that's some great growth. If you move these over, I don't know if that'll convert well. Maybe not. I got to reformula those. Quarter over quarter, that's some great growth. But you wouldn't say that we're going to make close to a third in annual sales if you're banking on literally doubling from Q3 to Q4. A doubling quarter over quarter is not what he's projecting. It's definitely closer to 400, so that he knows without a doubt, like surely Q4 is going to have the Q4 bump, just like it always does because it's holiday. And we're sitting on a $4.7 billion business. I'll save it for a future video as far as what are the implications of this on the valuation for the collectibles business. Because the reality is the collectibles business is also substantially more valuable than what I just projected. And even if you took what I projected it to be, that in itself already applies a 6x on the current stock as far as what it can fundamentally support in valuation. And it is growing way faster than that. It's growing close to a double on the backs of what? Power packs. On the back of power packs. Their non-power packs business might have been around 270, right? Their Lego plus PSA grading. You add in their power packs and it might be north of 400. That means their power packs revenue is maybe around $130 million in beta. In beta. Woo! I'm excited. I'll see you guys in the next one. Thank you guys for the chats. Sorry I wasn't too attentive to it, but if you learn anything from this, would love a like, would love a comment. I appreciate you guys so much for watching. Thank you to those who subscribe. I'm excited to continue to flush out the implications of Ryan Cohen's interview. But trust me, once you start putting the numbers and reading between the lines, listening to what he's really saying, the implications are that GameStop is growing fast. The collectibles business is growing fast, not at 30%, right? Not at 30%, not at 25%, not at 40%, not at 55%. The collectibles business is growing north of 80% quarter over quarter because of Power Packs sales. If that is not worth a premium valuation on an earnings multiple basis, I don't know what is. And right now, GameStop is valued cheaper than any other retailer in America. Craziness. All right. I will see you guys in the next one. I've really got to go, but thank you guys for being here. Later.